I want to bring in Charles Ortel, Newport Value Partners, because despite all this news, of course, you do see some clouds on the horizon, right, Charles? There's no way that you're taking any of this decline in the volatility index and saying, all right, things are great now, go ahead, everybody go and buy stocks. I got to think you're still a little bearish, right?
I think we've been taking some time, Pimm, and thanks for having me on, to look at the raft of data that was released on big companies in their annual reports or 10Ks to try to dig behind the numbers and get a sense for whether current valuations are rich or very inexpensive. And when we like to evaluate companies based on their value in relation to their free cash flow, and still, at these valuation levels, companies are trading at extremely high multiples of true recurring free cash flow.
But just a true recurring free cash flow, that's got to be slightly subjective, no?
You could do it very, very subjective, or you could just simply take cash flow from operations and subtract out cash from investing, leaving financing proceeds aside.
Okay.
And just do it, take the company's numbers without adjusting anything. And there you'll see, if you go over a long time series, that stocks remain trading at very, very high multiples in the main. They're also trading at extremely high multiples of market value to tangible hard book value. A lot of the big cap companies have been buying their shares back, not so much recently, but in the last 10 years, and they've shrunk their equity capital base. They've made a lot of acquisitions. So there's no safety in these stocks. And when you want to look ahead, we see a veritable gauntlet running in 2011. We have the domestic issues that we're going to start dealing with, I believe, on April 4th in the United States. The unions are getting together and they're going to protest what happened in Wisconsin and begin a protest against the large banking institutions, even suggesting that unions should stop, members should stop paying their mortgage payments to try to bring the financial system down, which I think is kind of risky. Then you have the European situation, which will play out this weekend in Germany, and then through the spring and summer, through May Day. And we could talk for a while about
Go ahead,
well, I just want to interrupt you on Europe for just a minute. I mean, the investors I talked to this week while Portugal was going on were saying, well, now we are more reassured that it is confined to Europe and that it's not going to have an effect on U.S. banks, for example. Just quickly, if you could.
I fundamentally disagree. I think the information coming out of most companies and governments is still quite opaque. And you have to take with a huge grain of salt what you hear from these big corporate leaders and big government leaders. You got to look behind the numbers. In our view, if you look at CDS spreads, which is another thing you could talk about, they've come way, way in. So volatility, CDS spreads are low.
We're going to, Charles, let's just turn to Europe for a second, because the Prime Minister of Portugal, Socrates, right, has resigned. The Parliament doesn't want anything to do with a big austerity package. The price tag is now about $100 billion. And the Germans have elections coming up this weekend. Is it possible that Angela Merkel's party suffers such a defeat that as a result, when everybody wakes up on Monday morning, they realize that this dream of a unified Europe really isn't going to stay together?
I think not only is it possible, it's probable. I think what we've seen in Europe now for, you could say, as much as 65 years, has been a long project in redistributing the wealth that had been created in the past. And what we're seeing over in Europe, we're seeing it in the U.S., is that it's very easy to create equality and poverty, but you're never going to efficiently redistribute wealth. You're going to destroy wealth in the process. And that's what's happened in Europe of late with this gigantic bureaucracy. We talked about their opaque accounting for corporations and for governments. And I think we're seeing different states in Europe finally address measures that in the United States we're only just beginning to cope with. You see in England now talking about lowering their corporate income tax rates to as low as 23%. In my view, the corporate income tax rate in the United States, we should be really bold and think about lowering it to, say, 10%. And going well beyond what Ireland did, keeping our rates low for that long period of time would attract a lot of capital into this country. With that capital, we get a lot more jobs. So I think you're seeing that kind of a debate in the North and the South in Europe. You have intractable problems in some of the Southern European states. You have intractable demographic problems, too many old people, not enough young people, great gaps in the education levels between those who participate on the world scale and those who are collecting collecting their welfare checks. So it's a very, very difficult set of problems that Europe is facing. We face the same problems, although our population is not quite as old.
Well, just sticking with Europe for a second, so then what in your mind accounts for the rise in the value of the euro against the dollar? The European Central Bank, according to some reports, is going to raise interest rates because they're concerned about inflation. Well, I mean, how do you square a valuable euro against the declining value of the U.S. dollar when you almost describe Europe as being more sclerotic than the United States?
QE2.
QE2, that's all, that
one.
encompasses it all.
I'd say that's one reason. I mean, we have been in this country on our monetary policy, starting with QE2, on our fiscal policy going back even to the Bush years, we have been completely irresponsible in terms of defending the value of accumulated wealth. And so Europe's been a little bit more responsible. They're still irresponsible. And I think that explains some of the reason for the relative strength of the euro against the dollar. Both currencies are sort of an insult to drunks to call them drunken sailors, but both currencies are both currencies that don't have a lot standing behind them.
So let me guess, if I patted you down, you might have a couple of gold coins somewhere? I mean, do you think that gold coins are the way to go? I mean, gold as an investment or as a hedge against the possible debasement of fiat currency?
I think absolutely physical gold is an interesting thing to accumulate. I think that volatility is going to reign. It's a safe prediction. It's going to be at higher levels than in the past. So if you're going to trade the market, there's an opportunity to follow the upswings and downswings of volatility. There's an opportunity to be in and out, let's say, on a daily or a weekly basis.
But let's say you're not into that. Let's say you want to actually try to sleep at night and not try to predict what's going to happen on a Monday or a Tuesday. Do you slowly move the majority of your accumulated wealth into something like gold or into a currency such as the Australian dollar or the New Zealand dollar? What do you do?
I like the Norwegian krona.
Norwegian krona?
I would consider the Singapore dollar. I would definitely be looking carefully at my equity portfolio to look at the stocks that have appreciated the most and decide which of those to sell and take a capital gain. I would think very hard about how much my money should be in fiat currencies and how much should be in other currencies. This is not a moment where there is an incredible margin of safety in securities of any kind. Interest rates are heading up around the world. That's got to have a negative impact on a lot of stocks and bonds. And in summary, this is a professional's market. This is not a market for the amateur.
All right. Now, you say that just as it seems a lot of the retail money, the money coming from individuals, is pouring back into the stock market out of bond funds. Is that a correct move? What should they do if they have money in bond funds?
I think you should get out of bond funds. You should put a portion of your money in as we mentioned, physical commodities and strong currencies. But rushing in now, when professionals are taking money, are retiring from the game, people like Stanley Druckenmiller, who's one of the world's most phenomenal investors, getting out of the market, and you're going to rush in at a retail level into funds, I just think that is folly.
All right, so now we know about some of the events that might occur this weekend in Germany, the election that's coming up. What about in the United States? The announcement this week that Federal Reserve Chief Ben Bernanke is going to be holding press conferences 4 times a year. They moved back the release of the FOMC minutes to 12:30. Is this a material event?
Well, I think it's good for more transparency is obviously very good. I'd really love to see the Fed's financial statements produced on something closer to the standard that large banks use. I think we need to have a lot more information, and I note the lawsuit that was won requiring recently the Fed to provide more information. That's all good things. I think the biggest short-term things that are going to happen in the United States have to do with what's happened out in Wisconsin, the aftermath of that, the fact that unions are using the judiciary to try to overturn the recent law that the governor got passed. I think you're going to see more and more of that, more militancy throughout the United States, which is going to be a major problem.
We got to leave it there, but I want to thank you as always very much, Charles Ortel, Newport Value Partners, sharing your thoughts and your ideas. Appreciate it.